All right. Today is Thursday, October 28th, and this is a recap for the stock market activities today. Folks, we got a major problem here. We have a pandemic of gambling in this country, and it couldn't be more evident than the stock market. For example, today we have the level of euphoria, arrogance, and ignorance reaching insane levels. This is no longer about investing or even trading. This is all about gambling. Today, they front-loaded the earnings from Apple and Amazon. They stampeded buying call options on steroids for the expiration date of, you guessed it, tomorrow. We all know what's going on after hours. The earnings came out short, and the likelihood is all of these call options will expire worthless. The market is not moving on organic buying and accumulation of positions. The market is moving higher via delta hedging due to the massive gambling activities in the market right now. That's all there is. So the question is how sustainable a market rally is when it's built on a flimsy foundation, a shaky foundation of gambling with very limited scope of weekly expiration. We will discuss this and a lot more in this program tonight. And here it is, in focus tonight. We're going to talk about the gambling pandemic in this country and in this market in specific. And then we're going to go over macro data, specifically the budget deal. And lastly, per usual, we're going to go over earnings reviews. We start with the story of the pandemic of gambling in this country. It couldn't be more evident than the stock market. On Monday, the stock of Tesla exploded higher on the fake news of a bankrupt rental car company, Hertz, ordering 100,000 Teslas, full option, not even the base model, and they're going to pay about $4 billion for that order, which was already comical and laughable how fake this news is. If you and I spread quote-unquote fake news, it doesn't have to be fake news. Sometimes you question the jab mandates, for example, and you have a Harvard study, you have a scientific study that supports a different opinion than the common narrative. You will be fact-checked by these big tech companies, and you will probably be deplatformed and censored. But we have news media organizations spreading fake news without fact-checking at all. It doesn't pass the smell test. Yet regardless, a fake deal worth $4 billion resulted in a gain of over $100 billion in market cap for Tesla. We now know what was behind the pump on Monday. It wasn't due to legitimate news or legitimate buying of the stock. It was due to a stampede of call options buying. And we are just learning about the magnitude of this stampede. Here is the headline from Market Insider. Bullish bets on Tesla stock reportedly made up 50% of all option trades this week as investors cheer EV makers surge to $1 trillion market cap. You know that we have at least tens of billions of dollars traded every day in the options market. We are talking about a massive amount of cash here. 50% of the entire volume in the options market was bullish bets on Tesla. A massive stampede of speculation, an irrationality, because they're buying call options way out of the money with the sole purpose of triggering a gamma squeeze and forcing market makers to hedge their delta via buying the stock. The majority of these call options were bought for the expiration date, you guessed it, this upcoming Friday, weekly expiration. So when you look at the massive move in the stock, pushing it to exceed $1 trillion in valuation, was it due to legitimate buying of, say, institutional investors or even mom and pops and retail investors who have faith in the company and they would like to invest money in it? Or is it just pure speculations and gambling, as if betting on horses or a roulette table in Vegas? And here are the weekly options for Tesla, and as you can see, they rolled from 900 to 1,000 and now to 1,100. Folks, we're talking about 100,000 contracts, more than 100,000 contracts, traded today for the 1,100 calls on Tesla, with 1 day left for expiration. And of course, they will try to push the stock higher to that particular price. They dump these options, and there we go, another pump and dump, lather, rinse, repeat. The level of euphoria and arrogance is so extreme when we look at the weekly expiration for tomorrow. The $2,000 calls for Tesla has over 6,000 contracts open right now. Somebody believes that the stock of Tesla will double in value by tomorrow. Total and absolute insanity. And we are now learning that this news of Hertz buying 100,000 Teslas is pretty much fake news. The numbers keep going higher and higher and higher, with no verification whatsoever. The headline reads, Hertz says it may expand supply of Teslas to Uber to 150,000. Wait a minute, I thought you ordered 100,000. Where will the extra 50 come from? Are you ordering cars or are you ordering soufflés from a bakery? Oh, we're sorry, we thought we're gonna need 100,000 soufflés, make that 150. Okay, no problem. You get a soufflé, he gets a soufflé, she gets a soufflé, everybody gets a soufflé. We just make up numbers out of thin air and run with it. And I say forget about the Berlin Gigafactory. It's all about the Hertz Gigafactory, where supply is endless. You can order however many soufflés you want. 100,000, 150, make it 1,000,000. Why not just make it 1,000,000? Hertz ordered 1,000,000 Teslas. We're talking about a bankrupt company that just emerged from bankruptcy, just got rescued and bailed out by a bunch of so-called venture capitalists who are probably creating a bunch of hype based on fake news right before the IPO. And soon enough, you're going to hear what we meant is to say that we're buying 100,000 Teslas as NFTs. This is, of course, going to come from Hertz. Just wait for it. The gambling fever doesn't stop here. Have you noticed the price action in Lucid Motors today? Another EV company rising at some point during the day by the tune of over 40% in a single day. Mind you, this is a company pre-revenue, pre-profits, no net income, no reporting whatsoever. And the valuation to begin with was about $44 billion for a company with no revenue and no profits. And the stock went higher today by 40%. Why? We had another stampede in call options, and I spotted the action in real time and tweeted about it. They bought the $30 calls, way out of the money, aggressively. We're talking about thousands of contracts right at the beginning of the day. The stock moves higher, and then they rolled to the 40. During the same day, they closed the 30, they rolled to the 40, the stock moved higher all the way to 40, and then they dumped and closed their $40 calls contracts, and the stock retreated. Massive pumps and dumps. The market is a jungle fueled by speculation, manipulation, and gambling. And somebody, of course, we have perhaps a mom and pop or a retail trader, for example, who bought Lucid at 40, or perhaps bought the $40 calls when the stock was already trading at 40. Maybe they bought the 50, buying the hype, and now they're losing money. Perhaps money that they need. But this is the disease of gambling in this market. And who gets away with the profits? The predators, of course, who are orchestrating these pumps and dumps. And where is the SEC, by the way? Mr. Gensler remains in a coma. Another example of the mania is the options grid for Apple. These are the call options, of course, with the expiration date of tomorrow. They bought hundreds of thousands of contracts out of the money with 1 day left for expiration before the company even reported earnings. This is the level of overconfidence and arrogance. They just assume that Apple will have or produce a decent report regardless. Who cares? The stock is just going to blast higher. They bought all of these calls, and you and I know what happened after hours. The report is abysmal, and the stock is down a little over 3% after hours, erasing all of the gains from today's session, meaning that all of these call options out of the money will expire worthless tomorrow. This is the disease, the pandemic of gambling. And we continue to have these geniuses, these morons on CNBC and the likes, the experts, quote unquote, who say, oh yeah, this is a great opportunity to buy. The stock market remains attractive, really. And we look at the S&P 500's earnings yield. Pay attention now. The earnings yield of the S&P 500, when you pin it to the CPI, it is reading at the lowest level since the 1970s, indicating that this is a lousy time to invest in the stock market because the yield of the stock market lags the CPI inflation by the largest margin since the 1970s. But of course, it doesn't matter. All of these facts don't matter to the crowd, who's in blindfolds, completely zombified, brainless zombies. They're not investors, they're not traders, they're not even gamblers. They're just brainless zombies hooked up on meth looking for the next score. Easy, quick score, spit the ticker on TikTok, Snapchat, Reddit, doesn't matter. We stampede, we buy, some win, some lose, some die, who cares? And this is, unfortunately, the nature of the market right now. A complete jungle without any rules whatsoever. We're not joking, of course, when we talk about a gambling pandemic. It is not just evident in the stock market, by the way. The Las Vegas Strip reports $2.1 billion in gambling revenue. This is the highest quarterly win in the history of the city of Las Vegas. The problem here, folks, is we have excess euphoria. The Fed printed money out of thin air, trillions and trillions and trillions of dollars. And folks now have money they don't even need. Extra money, stimmy money, crypto gains, stock gains, home equity, fake home equity, by the way, and they're using the money to gamble. This is reminiscent of the 1929 environment, the 2008 environment, and pretty much the environment that preceded every crash and an economic downturn. Next, we move on to macro. What's going on here in macro land when we start, of course, with this so-called Build Back Better plan, which is an epic disaster, by the way. Nothing is going on here. Nothing is moving. In the morning, Biden made it clear with Nancy Pelosi. Of course, he met with Bernie and Manchin and Pelosi, and he warned that the fate of his presidency and the fate of the Democratic Party relies on passing this multi-trillion dollars bill to achieve the so-called economic agenda of Joe Biden. And I say what agenda, by the way? How about making coal great again? Because the prices of coal are out of whack. Coal is the best performing commodity for the year. And of course, we have the Chinese with their ego. Their ego is bruised right now. They have a problem with Australia. Australia has an abundance of coal. China is short coal. They need coal. But of course, the ego, they refuse to import coal from Australia, and now they're importing coal from Russia. But anyhow, back to the domestic agenda here, the so-called Build Back Better plan. Nancy Pelosi in the morning cracked the whip. Pelosi specifically told House Democrats that she wants the infrastructure bill passed by the time Biden lands in Rome tonight. They did not want the president to land in Rome without a deal, because it is an embarrassment, by the way, to meet with all of these world leaders without a deal. You're pitching this whole green agenda, net carbon, whatever, zero by 2022, 2023, 2020, whatever. Yet you cannot even pass the deal in your own country. And guess what? Biden delayed his trip, by the way. And he came out in the morning with the fake press conference indicating that we have a framework, which was a lie, flat out lie. Yet the market reacted positively, shot up higher, and now Biden can fly with his head high. We got a framework, folks. It was a pure lie, no truth whatsoever. And of course, the deal slimmed down to 1.75 trillion. By the time the deal is over and agreed upon, it will be about 1 trillion, if not less. So all of these promises that you got, paid leave and sick leave and cheap drugs, not going to happen. Stimmy is not going to happen, folks. The priority is the billionaires. How can we pass public money to the billionaire class? We can trim the deal for the yayo that's about to land on your head, your paid leave, your benefits. We can compromise by cutting that out of the deal, but we're never going to compromise by cutting the billionaire's benefits out of the deal. I'm spitting a lot of truth right now. Anyhow, before we get arrested, after the fake press conference, it wasn't actually a press conference because he refused to answer questions. President Joe Biden. He just spit out a bunch of lies and walked away. Right away, we started to hear from our senile leaders, and it became abundantly clear that we don't have a deal. There is no agreement whatsoever. Let's listen to Nancy Pelosi and Bernie Sanders.
We've been hearing from a lot of progressives who say they would still not vote for this package. So is it premature to move forward with a vote on the bipartisan package today? And do you trust that Senators Manchin and Sinema will vote based off of what is outlined in this framework?
Well, I trust the President of the United States. And again, the text is out there. If they have anybody, any senator, any House member, have some suggestions about where their comfort level is or their dismay might be, then we welcome that. But I trust the President of the United States. We will. We have, all the things I named, we have agreement on most of those things. Now, when people see the language, they may say, well, this goes more further than I thought. I don't know. We'll see what they say back.
Let me just say a few words. Number one, I think before there is a vote in the House on the infrastructure bill, the members of the House have a right to know that 50 U.S. senators are supporting a strong reconciliation bill. Number two, I think if you look at the bill that the President announced today, it is probably the most consequential bill since the 1960s in terms of protecting the needs of working families, our children, the elderly, the sick, and the poor. It is a major, major step forward. But clearly, to my mind, it has some major gaps in it. The American people are very, very clear that they are sick and tired of paying the highest prices in the world for prescription drugs. There is, to the best of my knowledge, no language in there that takes on the pharmaceutical industry, demands Medicare negotiating prices and lowers the cost of prescription drugs in America. And that's a major problem in the bill. The second lacking is, I'm glad to see that hearing aids were included as part of an expansion of Medicare. But I would very much like, the American people would like to see eyeglasses and dental care as well.
And right away, you guessed it, we don't have a deal. No deal. No infrastructure vote tonight, as Nancy promised, by the way. No deal. Gone. And of course, conveniently, the announcement of a no deal happened after the market closed. God forbid stocks might go down while the president is traveling overseas. What an embarrassment for the country, right? And just for our friends overseas who are not familiar with American politics, it's a freak show to begin with. But here's the Democratic Party. It breaks down to the socialist wing. This is the Bernie Sanders AOC wing. And of course, their strategy is money solves all problems. If you spend more money, problem solved. MMT on steroids is the answer for everything. And then we have the corporate wing of the party. This is the majority of the party, the Schumers, the Pelosi's, and their goal, of course, to pass more money to their corporate donors and make them richer. Then we have the Republican wing of the Democratic Party, and this is represented by Senator Joe Manchin of West Virginia. And then we have this new antique Sinema from Arizona, who's a fake senator, by the way. She's not even interested in doing the job. She's going to be out in the next cycle. And surprise, surprise, after that, you're going to hear that former Senator Sinema got a job with Goldman Sachs or BlackRock, and she gets paid millions of dollars. But the Republican wing of the Democratic Party, their interest is to cater for a different type of billionaires and Wall Streeters. See, the corporate wing of the Democratic Party, they cater for the Wall Streeters and the billionaires who benefit from passing a lot of yayo, a lot of government spending that magically lands in their pocket. The Republican wing of the Democratic Party, just like the Republican Party, the actual GOP, they cater for a different type of Wall Street and billionaires. The energy corporations, the big pharma, yada, yada, yada. But in a nutshell, companies and billionaires who benefit from cutting taxes. They do not necessarily benefit from extra spending. They do benefit indeed by cutting taxes. And this is, of course, American politics in a nutshell for you. One party caters for the billionaires who benefit from extra spending, another party who caters for billionaires who benefit from lower taxes. And of course, they're never going to teach you this in any class in this country. But I just broke down American politics for you easily. Now, on the ground, the situation is disastrous. The supply chain crisis is getting worse and worse and worse by the day. We have empty shelves in certain stores. We have goods and products rotting in these shipping containers just sitting there. The goods will not be good anymore by the time they're unloaded and delivered to the customer. And the reason is we have a massive shortage of truckers. To be exact, we're short about 80,000 truck drivers. How the hell are we going to find 80,000 truck drivers right now? You're going to have to train them. You're going to have to license them. You're going to have to pay them a lot more to begin with. Oh, and on top of that, you got to let go of these draconian jab mandates. Otherwise, truckers are not taking the job. We also got news that the GDP went higher by only an abysmal 2% in the third quarter. Remember when the Fed and the Wall Streeters and the likes told us that the growth in the third quarter for GDP will exceed 7%. Garbage. Absolute garbage. And now we know that the economy is slowing down significantly. The so-called V-shaped recovery. The economic boom that we're living in right now, which is in reality just another stagflation crisis, by the way. And that leads us to the Fed and Jerome Powell. What's going on with the monetary policy? We know the fiscal is in chaos. What's going on with the monetary? Well, Powell says we're not going to taper, we're not going to raise interest rates and normalize the economy by removing the so-called accommodative policy to Wall Street until and unless we reach quote-unquote maximum employment in the economy. Well, Mr. Powell, we have a massive labor shortage. We have more jobs available right now than workers looking for jobs. Workers are just not motivated at all to fill these jobs. They have other alternatives in this economy when liquidity is abundant. Isn't this the definition of maximum employment when you have more jobs available than employees looking for these jobs? But we're getting more evidence here of more improvement in the jobs market, meaning getting closer and closer to what? To monetary tightening. And remember this, good economic news are bad news for the stock market. Why? Because the stock market has been a coke addict. The only fuel pushing the market higher is the tsunami of liquidity from the Fed, enabling all of this speculation in the stock market that we just talked about. If we have good news, good economic news, then the so-called liquidity and accommodation is not needed, and the gap between fair valuations in stocks and current valuations is massive. And what's causing this massive gap and distortion in valuations is the yayo coming out of the Fed. Remove the yayo, valuations go down to fair market value, which is a lot lower than most of these stocks trading right now. Here is some good economic news for you. Filings for unemployment benefits declined last week to their lowest level since the coronavirus pandemic began, as employers competed for employees. It has been a challenge for employers, especially in low-paid service jobs, to keep workers on staff. This, of course, will push the Federal Reserve to tighten the policy faster and perhaps in a more aggressive fashion than expectations. Matter of fact, the market is starting to price in more interest rate hikes than the Fed is indicating. Watch out here. This is a game of expectations. The market is saying the Fed is bluffing. They will have to raise interest rates abruptly because inflation is rising out of whack and we have a recovery ongoing in the job market. And this wash of liquidity is not needed anymore. But you and I know the economy is already on life support. Every improvement that you have right now is fake, be it economic or market-wise. It is only done via fake money being printed out of thin air. We have to continue to maintain this charade on and on and on because the moment you pull the rug, you remove the accommodative policy from the Fed, and the whole charade goes down. The whole house of cards collapses. Everybody assumes that the Fed will never do that because they know the economy and the market is on life support, and this life support needs to go on forever. The problem is inflation will force their hand to tighten abruptly and against their wishes, of course. And this will be the biggest economic disaster since the financial crisis in 2008-2009. The fate of Jerome Powell is also uncertain. Uncertainty over the Fed leadership clouds policy questions. Presidents have typically announced their nominee in October or by early November to give the Senate sufficient time to confirm their pick. Trump announced Powell to succeed Yellen on November 2nd, 2017. So what is Biden waiting for here? Does he want to renew the tenure of Jerome Powell, his biggest political enemy right now? Because this inflation crisis was created by Powell, and Biden is eating the blame for it. Of course, the insane policies from Joe Biden are not helping inflation to tame down, but the creator, the initiator of this inflation crisis is Mr. Powell. So is Biden naive enough to renew the tenure of this man, or will Biden go with another Fed chairman or chairwoman? We know they're looking at brain dead, of course. And how will the market react to this news? The market is addicted to liquidity. The market is addicted to Jerome Powell. The best thing that ever happened to the market is Jerome Powell. Removing Powell will not be received warmly in the stock market, and the likelihood is he will be removed because under his leadership, the Fed is behind the curve. We have other central banks across the world already jacking rates higher. For example, in Australia overnight, we heard the news, the Commonwealth Bank of Australia brings forward its forecast for the Reserve Bank's interest rates increase by 6 months to November 2022 after upgrading its economic outlook. Now, let me fix this headline for you. Here it is. Not upgrading its economic outlook, it is upgrading its inflation outlook. And therefore, they're hiking interest rates faster and sooner than expectations. And this is exactly what will happen with the Fed's policy. Lastly, before we dive into earnings, we continue to monitor the economic disaster over in China. As you will see from corporate earnings, there is a massive economic slowdown in China, and now we are facing the risk of stagflation in the Chinese economy. The headline reads, "Stagflation in China is a very real risk in the next couple of quarters," says analyst. You will see that indeed things are stagnating in China from the earnings I'm about to present for you. And here it is, the earnings that we got today, starting with Merck, followed by Caterpillar, Starbucks, Apple, and Amazon. I was not worried about Merck to begin with. I told you I'm not going to even cover the financial results for Merck. I know the stock will go higher. It is all about the pill. Good news about the pill, the stock moves higher. There is more excitement here. This is a sleeping giant, and now it is waking up from the dormant status it has been on for over a year. Drug maker Merck raises its annual forecast after posting quarterly profit and revenue that beat Wall Street's expectations. So they beat on the top and bottom lines. On top of that, here comes the pill, of course. Merck sees up to $1 billion in COVID antiviral pill sales. It just needs regulatory approval. Why are they not getting the approval? Of course, because our health officials have this tunnel vision that the jabs are the answer for everything. And unfortunately, their tunnel vision is costing lives, and it's about to destroy the economy with all of these draconian jab mandates. We got more news from Merck, They're sharing the patent for the pill. The headline reads, U.S. pharmaceutical giant Merck has agreed to share its license with a nonprofit so that its experimental COVID-19 drug, whatever that is, can be manufactured widely around the world in a deal that would expand access in more than 100 countries. You hear that, Moderna? We also have analysts for Morningstar, and they're upgrading their outlook for Merck. The analysts say that the fair value for the stock is around $94. The stock is trading around $81.50. So it is at a 13% discount from fair value. Next, we have Caterpillar, a classic inflationary stock, and it is, of course, delivering as expected. These inflationary stocks enjoy pricing power, and these are exactly the kind of companies we're looking for. Caterpillar earnings beat expectations as demand for heavy machinery across the construction and mining sectors outweighed ongoing supply chain concerns. The revenues year over year are up. Operating profits, so did the profit per share, remarkably higher year over year. And here are the numbers and details. What I was looking for is the machinery segment of the business and the rate of growth year over year. The revenues were up about 27% year over year. This is decent, of course. Now, when we look at the different regions of the business, the main concern was in China, the Asia Pacific. Well, in North America, the revenues were up 31% year over year. For Latin America, a stunning 77% year over year. For Europe, Middle East, and Africa, 24% year over year. And lastly, Asia Pacific, weaker, but be it positive 8% year over year. So the weakness in China is clear, not just from this report, but as you will see from Starbucks, Apple, and many other companies. Now, what about the margins? Because this is the story this earnings season. Can companies hike prices higher, exercise their pricing power, and how recipient the end customer would be? We will look at the profits for different segments. For construction industrials, the profits were up 47% year over year. For resource industries, a stunning 78% year over year. For energy and transportation, 41% year over year. And lastly, for all other segment, this is a smaller segment, of course, the profit was down 81% year over year. All in all, for the entire business, the profits were up a stunning 69% year over year, indicating that yes, expenses are rising higher, but Caterpillar is exercising its pricing power, jacking prices higher, and the customers are paying more, and therefore their operating profit margin is expanding higher. And unfortunately, I have bad news for you. Here we have another one. Caterpillar may hike prices again, experiencing production delays. Mind you, Caterpillar already raised prices twice this year, and now it says it will have to do it again to offset rising costs. So prices will go higher and higher and higher with no stop in sight whatsoever. And here we have another one. Even Verizon, even your phone bill is about to go higher. Verizon is hiking prices. Next, we have Starbucks. We knew right away every time a company before earnings, they release some bad news, you just want to get it out of the way and test the waters. It is a sign that the earnings report will be disappointing. Yesterday, we heard the news that Starbucks is hiking wages from $15 to $17 an hour. And now we have more details about the reason behind the hike in wages. Facing twin pressures of a union challenge and a labor shortage, Starbucks announced Wednesday it is hiking wages for U.S. employees. So this was the setup before earnings. And I told you, investors are already distracted from Starbucks. It is trading at all-time highs. Even if the earnings report is impressive, the stock will go down because we have Dutch Bros, we have other opportunities. But most importantly, we were watching for the slowdown in the Chinese economy. When we look at the results, in the North America segment, the store sales were up 22% year over year, the revenues were up 37% year over year, and the operating income was up a stunning 148% year over year. On the other hand, the operating margin was also decent, up 21% year over year, almost 22%. These are all decent numbers, but they are inflated, of course, because last year we were at the heat of the pandemic lockdowns. Nobody was buying stuff from Starbucks. Now, when we look at the international segment, store sales were up only 3% year over year. The revenues were up 27% year over year. The operating income was up 108% year over year. The operating margin was up about 20% year over year. These are all decent numbers, of course. But again, the base effects are inflating these numbers higher. You need to go ahead and compare the numbers that we have right now with 2019's. And they are improving, of course, but the business is slowing down. Where is it slowing down? Here's the answer. You guessed it, China. Starbucks revenue misses after China's COVID resurgence hurt sales. Correction, it's not COVID resurgence. There is a massive problem in the Chinese economy, and this is of course ties up with Evergrande and the real estate crisis over in that country. China saw same-store sales shrink by 7% in the quarter, missing Starbucks' prior forecast of flat same sales growth. This is the reason for the disappointment and the reason why the stock is trading down after hours. Next, we have the big kahuna, Apple, the iMob, and the iMob disappointed big time. Apple sales missed expectations. Tim Apple says supply issues cost the company $6 billion. Here is the report on what I usually look for in Apple's earnings. I am looking at net sales for the two different segments, products and services. Then I look at the cost of sales, the gross margin, then the net income, and finally, the sales per region and per product. We will look at the year-over-year numbers. Of course, I told you in my earnings preview video, this will be an easy beat because it was a lousy quarter last year. The numbers are very easy to beat, so this is not impressive. And I will illustrate this for you in a second. Products were up 30% year over year. The services, aka the shakedown business, the revenues were up 25.5% year over year. Meanwhile, the total net sales, all in all, were up 29% year over year. Now, what about expenses? Because if your revenues are growing faster and larger than your expenses, then the business is fine. Well, expenses went higher by 20.5% year over year. Pin it against net sales, 29% versus 20.5%. Sales are growing at a faster pace than expenses. All in all, the gross margin was up 42.5% year over year, and the net income, the profit, was up 62% year over year. Now, you might say that these are impressive numbers. What's going on here? Why is the stock trading down? We have to put everything in perspective, of course. When we look at the quarter-over-quarter numbers, the problem becomes more evident. Net sales were up 2.3% quarter over quarter. On the other hand, expenses were up 4.3% quarter over quarter. All in all, the gross margin was down, a negative number of a little over 1%. A little less than 1%. When we look at the net income quarter over quarter, the number was down 5.5%. So again, Apple is slowing down. And this was supposedly the quarter where the sales of the iPhone 13 will expand Apple's margins across the board. Not true at all. As you can see, the quarter-over-quarter numbers, the business is slowing down dramatically. When we look at the numbers, the net sales per region, for the Americas, the number was up 20% year over year. For Europe, the number was up 23% year over year. For Greater China, the number was a stunning 83% year over year. I was actually looking for over 100% year over year because it was a lousy quarter last year. In Japan, the sales were up 19% year over year, and the rest of the Asia Pacific segment was up 25.5% year over year. Now, when we look at the net sales by product, the iPhone was up 47% year over year. The Mac was up 1.6% year over year. The iPad was up 21% year over year. The watch wearables were up 11.5% year over year. And lastly, the shakedown business, the iMob business, was up 25.5% year over year. So you might ask, what is the problem here, bro? Why is the stock down? Here's why. When we look at the quarter-over-quarter numbers, sales in the Americas were up 2.6% year over year. Sales in Europe were up about 10% year over year. Here's the problem, of course. Sales in China were down 1.3% year over year, yet another evidence of the economic slowdown in China. And then we have the sales in Japan down a stunning 7.33%, and the rest of the Asia-Pacific region was down 3.75%. We look at the sales by products quarter over quarter. The iPhone was actually down. This is stunning, 1.77%. This was supposed to be the iPhone 13, the excitement, yada, yada, yada. The so-called super cycle, as Don Ivis would say. Well, there is no super cycle here. Sales for the Mac quarter over quarter were up 11.5%. The iPad was also okay. The growth was 12% year over year. For the watch, sales were pretty much flat quarter over quarter. And the shakedown business, the growth was 4.5% quarter over quarter. So again, it is a game of expectations, of course. These are not bad numbers, by the way, even quarter over quarter. But the problem is the expectations. The expectations were that sales of the iPhone will blow your mind away and sales in China will accelerate. This is not the story here. We have the opposite. We have a slowing down in the business, and therefore the stock is trading negatively after hours. Apple said supply constraints were worse than expected in its fourth quarter. Here's the important part, by the way. Crimping revenue and expects them to cause larger, pay attention now, larger headwinds this quarter. What does that say? Please dump our stock. We're not going to do good here. The supply chain crisis is larger than anybody anticipated. Next, we have Amazon. Here's the headline: Amazon earnings missed on nearly every metric. The stock is sliding. Let's take a look at the numbers, and ooh, what a disaster. This is the worst report in all of the big cap technology names. When we look at the sales in North America, for example, year over year, the number was up 10.5%. The problem is the quarter over quarter numbers. I told you, the same quarter last year was lousy, so the beat was easy year over year. Across the board, no problems whatsoever. They even managed to miss on that one too. The net sales quarter over quarter in North America were down by about 3%. And then when we look at the operating expenses year over year, they were higher 13%. Pay attention now. Expenses rising higher than your sales year over year. They're also rising higher quarter over quarter. What does that mean? Your operating income will be down. Year over year, the operating income was down a stunning 39%, but the number quarter over quarter was a disaster. An epic disaster. The operating income was down 72% quarter over quarter. Absolute disaster here. For the international segment, the sales year over year were up 16%, and quarter over quarter, the number was down 5%. We look at the operating expenses, they were up 21% year over year. Once again, expenses are rising higher than net sales. This is a major problem. We look quarter over quarter, operating expenses were down 1%, but keep in mind that quarter over quarter, net sales were also down 5%. All in all, we have an operating income loss year over year and quarter over quarter. Disaster across the board. The silver lining here for Amazon's earnings is the AWS segment remains growing. It remains constant in terms of growth. We have net sales up year over year by 39%, quarter over quarter also up 9%. Operating expenses, pay attention now, operating expenses are up 39% year over year. So even in the so-called high growth segment of the AWS, inflation is eating away their margins. Now, when we look quarter over quarter, the operating expenses were also up 5.7%. All in all, the operating income remains positive for the AWS segment year over year, 38%, quarter over quarter, 16.5%. Now, had they missed in the AWS segment, this stock would have been down 10% at a minimum. And here it is, the numbers for net sales, just for illustration, to show you that the business is slowing down dramatically. In 2020, the net sales growth in North America was 39%. This time around, it is down to 10%. For the international segment, the net sales last year, they were up 37%. This time around, they're only up about 16%. For the AWS, however, the growth last year was 29%. The growth this year was 39%. So you have one segment of the business, the AWS, still performing, but the core business is slowing down dramatically. The headline reads, Amazon's latest results were weighted down by ongoing product shortages, higher labor and shipping costs, and more. The fourth quarter might not be much better. So the company once again is warning, please dump the stock. We're not going to perform here. We have a massive labor shortage. We have a massive cost problem. It's a crisis. All in all, we're not going to perform in the next quarter either. In the meantime, you have the speculators and the gamblers on the institutional and the retail side alike, so emboldened by the arrogance, the overconfidence, and they decided to bid Apple and Amazon higher pre-earnings, front-loading the earnings before they're even announced. And yesterday we got the warning, by the way. This headline is from yesterday, from the Wall Street Journal. Amazon's earnings expected to suffer as growth slows, labor costs rise. E-commerce and cloud computing company tries to navigate supply chain and staffing challenges to maintain growth. Again, this was the headline yesterday before earnings, but don't try to bargain with the gamblers, the zombies, with their blindfolds on. This is a clear illustration of the reckless, irresponsible speculation in the market right now. Of course, we have many other news to go over. For example, the whole Meta thing with Facebook. Zuckerberg, of course, is a Machiavellian genius. They are not going to be able to take this guy down or cancel him easily because he is a genius. And he knows if you don't like the conversation, change it. And this is exactly what he did with the whole Meta thing, whatever that is. I say we should change the name to Meth, since Facebook and Instagram are so addictive. And the memes are rolling, of course. The bottom line is, nobody's talking about the documents or the whistleblower or the crimes of Facebook. Everybody's talking about Meta, mission accomplished. Therefore, Zuckerberg remains a genius. They're not going to be able to take this guy down. The problem is they can still take the stock down. Facebook stock, that is. Therefore, I'm not interested at all in a stock that is already trading below the 200 days moving average. So whatever pump we got today, it will probably be dumped very soon. And speaking of charts, let's move on to charts right away because I'm already recording this one too late. I don't want to release the video by midnight, so let's get it on already. Here we go with the charts, starting with the 30 minutes chart of the SPY. The chart flushed down all the way to the support of 454. We still have negative divergence on the RSI indicating weakness. However, the SPY managed to pop higher today, and the reason is they front-loaded these earnings ahead of time. We're talking about Apple and Amazon. Of course, Tesla remains another story, another hot story. And these three stocks, Apple, Amazon, and Tesla, if they rally higher by over 2% apiece, they're going to keep the SPY, but in specific the NASDAQ, trading higher, regardless of any weakness in the market, all in all. And therefore, the SPY is trading higher, and I call the drop that we got before the bell yesterday as a bear trap. Could the pump that we got today be a bull trap? It certainly appears so, because if Apple and Amazon are trading down big in the morning, down 3% apiece, these two will be good enough to push the NASDAQ and the SPY down. Now, Tesla remains the wild card. We have the 1,100 calls. They're going to try to push the stock higher to close these calls at a profit. But if Tesla reverses and also starts to trade down, then we have Apple down, Amazon down, Tesla down. Probably Facebook will lose all of the gains today. So just by knowing that, it doesn't appear or shape to be a good day tomorrow. It appears to be that we're going to have a bad day in the SPY and the NASDAQ. And if that is the case, then the same analysis that I did last night is applicable, because the support will be all the way down at 454, but in all likelihood, if that support is broken, then we're going to go down all the way to 447. It will probably not happen by tomorrow, by Friday's closing, but if we trade down, in all likelihood, next week will be ugly, and the gap, at least at 447, will be closed. Some of these gaps will have to be closed. Not all of them, of course, but the chart will have to go down to close some of these gaps. And therefore, my question is this a bull trap? Let me know what you think in the comments. Moving on to the daily chart for the continuous contract in the SPY, the momentum indicators are ridiculous at this point. The MACD and the RSI trading out of whack. They're elevated. They will be pulled back 100%. The green columns on the histogram of the MACD are getting shorter. The volume is also creeping back into the market. Now, from a candlestick pattern, we had the shooting star followed by a confirmation of the weakness. And the chart of the continuous contract for the SPY, the S&P 500, closed below the support of 4,549.5. And therefore, I call it a bear trap because we had every indicator that the chart should trade down. And therefore, when The SPY traded higher in the morning. This was a pie in the face right away, and the pie in the face accelerated the move higher. Why? Because we had shorts saying, you know what? I shorted with the assumption that we had a shooting star pattern, a reversal pattern, and now the chart is trading higher. They're just going to push it higher. I gotta give up. These, of course, are the what I call the pussy bears who freak out right away every time the market trades higher. But we now know that perhaps it is a bull trap, not a bear trap. And if you held your ground, you would have been rewarded rather than being weak and covering right away. Moving on to the Q's 30 minutes chart, what's going on here in the NASDAQ? It is also trading higher. We had what it appeared to be a reversal last night, or yesterday I should say, only to be surprised by a nice warm pie right in the face. But what do you know, the NASDAQ trades higher. Why? The gambling mania of front-loading earnings ahead of time, buying calls on Apple, pushing the stock higher by over 2%, buying Amazon and pushing that stock higher, buying call options on Tesla, pushing that stock higher. Now you have multi-trillion dollars worth of market cap, worth of weighting in the NASDAQ being pushed higher. Where do you think the Qs will trade? They will trade higher, even though we had underlying weakness in the breadth of the market, in the breadth of the NASDAQ. Yet the index traded higher either way due to the weighting of these three giants. It appears that we are in a wedge pattern which will be broken sooner or later, and the next support, the next solid support that I see is around 372, and that will be a steep correction from the recent rally, the recent rebound higher. When we look at the daily chart for the continuous contract of the NASDAQ, again, the MACD, the RSI, already topping, highly extended right now, indicating that this is a sell zone. And the question is, was today's action a bull trap, giving everybody the convenience and the reason that the market will just continue to go higher and higher and higher, forcing bears to capitulate and motivating the retail side, specifically the speculators and the gamblers waiting on the sideline, to be emboldened to buy call options out of the money with the expiration date of tomorrow, and therefore we're seeing the pop higher. And again, I raise the question, is this a bull trap? Because the earnings so far from the giants, Facebook slowing down, Amazon slowing down dramatically, Apple slowing down dramatically. We have Google and Microsoft still intact, slowing down a little bit, but the growth remains intact in these two names. Can the NASDAQ rally higher with Apple being shot, with Amazon being shot, with Facebook being shot? I doubt it. I think the NASDAQ will weaken tremendously, specifically after this week when the majority of call options on Tesla expire. Then that name could go down, and then we have Apple down, Amazon down, Facebook down, Tesla down. Can the NASDAQ continue to rally higher based on Microsoft and Google alone? And bear in mind that the earnings from Microsoft and Google were not that impressive, at least to my standards. The growth slowed down dramatically from last quarter. On the other hand, we're getting earnings from companies, I should say, with actual solid earnings, with actual pricing power. And in this inflationary environment, you want to stick with companies with growing margins and a decent pricing power. For now, it appears that Apple, Amazon, Facebook, they don't have the pricing power. They're also getting hit by this inflation and supply chain crisis. Next, we have the 30 minutes chart of the IWM. Again, the reversal out of oversold conditions. The chart did not go all the way down to 223 or to close the gap. It is blasting higher, forming a bull flag. I am hesitant to place the bull flag here and say, you know what, the Russell 2000, the IWM will trade higher above 229. I'm hesitant because I believe that this is a bull trap here. We have weakness across the board, and I believe if the NASDAQ goes down, in theory, we have a rotational market. The IWM should be outperforming. But again, I believe that the negativity will wash across the market because it is surprising that these tech giants, we assume they will have the pricing power, they will be able to withstand the inflation storm. Now we know that we're wrong in our assumption. When I say we, I mean the morons in Wall Street, the so-called analysts. They got it wrong. The big tech companies are also suffering from inflation. This is a major problem, folks. And therefore, I believe that the IWM, the Russell 2000, will also pull back tomorrow. What about the Dixie? The Dixie showed a lot of resilience, hugging the 93.7 support. And what do you know? Tricky Dixie actually flushed down today. But hold your horses, Tricky Dixie might trick you once again. You might assume that the Dixie is done here. It's going to flush down, only to be surprised by Tricky Dixie popping higher again. The reason for the flush down in the dollar today was we had meetings from the ECB and the Bank of Japan, and the market's take from these meetings were to push the Japanese yen and the euro higher, and this in turn, of course, will pull down the US dollar. But is the push higher in the Japanese yen and the euro sustainable? Of course not, at least not to me, and therefore I say beware, because Tricky Dixie might pop higher again. I confirm the moves in the US dollar by looking at the chart of gold. For example, if the dollar pops higher and then gold flushes down, then I have a confirmation that the pop in the dollar is sustainable. On the other hand, if the dollar flushes down and gold fails to pop higher, then I don't have a confirmation of the weakness in the dollar. When we look at the chart of gold, gold did not do anything today at all, just staying right there, parked, doing nothing at all. So we don't have a confirmation of the weakness in the US dollar. And by the way, unfortunately, I have bad news for the gold bugs. We have more dumping here from institutionals. Gold demand fell in the third quarter as big investors sold, says WGC. Of course, everybody's distracted right now with the tulip market. Even institutionals are pulling money away from gold and buying Bitcoin and other tulips. Now, when we look at the chart of the 10-year yield, the channel is broken. We had higher highs and higher lows. Pay attention now. We still have higher lows. Yes, the channel is broken, but the chart continues to maintain higher lows, indicating that perhaps the weakness that we saw in yields is only transitory, and yields will continue to pop higher on the 10-year until and unless this chart closes below 1.5% from a weekly perspective, then we don't have a confirmation of any reversal whatsoever. And here is the weekly chart for the TLT. Again, it looks good for now, but it all depends on the weekly closing. Will the weekly closing be above or below 149? Below 149, then the outlook remains the same. Yields will pop higher to reach 1.7 if not beyond that, and the TLT will go down to 134.5 at a minimum. However, a weekly closing above 149 for the TLT will change that outlook. We'll talk if it happens. And here is a chart of the VIX 4 hours chart. The pop continues. We have a bull flag right now. The MACD remains positive, indicating that the VIX is building the energy for the pop, eyeing 20. Could it happen by tomorrow? It could. And if it happens, the SPY will pull back dramatically. Market bears are eyeing a closing above 20 for the week. It's a long shot, but it could happen. Market bulls are betting to crush the VIX again on Friday. The VIX is already crushed, by the way. It is already trading at around 16.5. So we'll give this one to market bears that the VIX will pop higher tomorrow. The problem is I cannot guarantee that the VIX will close above 20 for the week. If it does, then we have a major bear win in the market and perhaps a confirmation of the market reversal. And here it is, the chart for Apple, a daily chart. The pop above 150, the bull flag should have happened after earnings, but the geniuses decided to front load the earnings and pop the chart higher ahead of time. This is a sign of overconfidence and perhaps arrogance from market participants. If the losses after hours persist, then the chart of Apple will lose the support of 150, and perhaps it will lose the support of 145. If the chart closes above 145 for the week, then there is still hope that this chart will work its way higher in the upcoming weeks. However, closing below 145 for the week will be a major ominous signal, not just for Apple, but for the entirety of the market. And here is a daily chart for the souffle Tesla. We have bearish signals here for multiple shooting stars, perhaps a hanging man right now, but it doesn't matter. This is the chart that defies all technicals. And the reason is it gets pushed via options. Options participants are eyeing 1,100. They're not going to rest unless they get that number. If they get that number, they're going to start to close their call options. The process of profit taking will initiate the reversal, and the chart will go down all the way to the trend line eventually. Absent of consistent call option buying. What do I mean by that, by the way? Look at the options grid for next week. They're not buying calls for next week. They're not buying calls for the monthly expiration in November. They're buying calls with the expiration date of this week. And on Monday next week, lather, rinse, repeat. They will try to buy call options again for the same weekly expiration. They're going to continue to do this over and over and over again. They have been doing this over and over and over and over. At some point, something got to give because the technicals are extremely extended and the implied volatility is surging higher, meaning that the risk versus reward is shrinking. You are paying more for premiums right now in Tesla options. The so-called whale who's been pumping the stock higher ahead of time, they've been doing so when the implied volatility of Tesla was extremely low. almost zero. So they've been scoring good and big. And this so-called whale is very intelligent. They're watching the options market like a hawk. They're watching the technicals like a hawk. They know when to get in or when to get out. When they watch the technicals, the overextended technicals, and the overextended implied volatility, the risk versus reward, they know that the time for the dump has arrived. Because now the retail side, the mom and pops, are noticing this and they're buying call options on Tesla on steroids. They're buying the $2,000 calls for tomorrow's expiration. Again, Tesla whale is an intelligent trader. He knows exactly, or she knows, what they're doing. We have no clue what the identity of the Tesla whale is, but we kind of know who he is. Anyhow, moving on to tulips, what's going on in BTC? BTC moving a little higher here. It is still bearish. The momentum indicators are slowing down. But again, if the stock market is a jungle, then the tulip market is a swamp. What do I mean by that? Let's zoom in a 30-minute chart. This is what happened today. BTC flushed down from 61,000 all the way to around 57,500. This is a massive loss that happened in seconds, only to be reversed right away. What's going on here? Who's pumping? Who's dumping? Nobody knows. It's a swamp, and of course the SEC is in a coma. And here is another tulip, by the way, Shiba. What's going on with Shiba? It is trading down for a little bit. We have the dreaded Twin Peaks on the RSI, indicating that perhaps the momentum already topped. However, when we zoom into a 30-minute chart, perhaps we have a bullish pattern here. We have a descending, sloping line of resistance. We have a double bottom. Can the chart gather the energy to break above the sloping line? If it does, then we have higher highs in Shiba coming. If it fails, and you see in the 30 that the chart is trading below the double bottom, then the mania is over in Shiba, at least for now. Lastly, what about AMC? What's going on here? 30 minutes chart, no love for AMC at all. This is the boomer stock right now. The cool cats are not interested in AMC anymore, and therefore it continues to melt down, and we're now eyeing the support of 32. There is still hope that 36.5 will be recaptured, but you have 1 day to do that by the end of the week, meaning tomorrow. And if the chart fails to close weekly above that number, 36.5, then you know right away the next destination will be 32. And you better hope that 32 will hold. Anyhow, moving on to the conclusion of this video. What do we have on the earnings calendar tomorrow? We have AbbVie and Chevron. Chevron I'm positive on. AbbVie not so hot so. I own the stock, but also own puts in case a disaster happens. And of course, we'll reassess after earnings whether to keep the stock in the portfolio or not. What about the economic calendar? What do we have tomorrow? We have a lot. A busy day when it comes to the economic calendar. We have personal income. We have disposable income. We have consumer spending. We have core inflation. We have the employment cost index. We have the Chicago PMI. And perhaps most importantly, the University of Michigan consumer sentiment. This will be the final reading. All of these numbers will be important. But are they going to make or break the market? I doubt it. We already know that inflation is surging out of whack and the picture in the jobs market is improving. We already know that tapering will happen. The surprise element is if raising interest rates happens faster. All eyes right now are on earnings. How will the market receive the earnings from Amazon and Apple? Are they going to rebound tomorrow or not? Are we going to have dip buyers or not? Lastly, what's going to happen with Tesla and options expiration? The answer to these questions hold the key to the market, whether the market is going to continue to go higher or will it reverse for real this time around. Anyhow, folks, this is all I got for you for now. Thank you for watching, thank you for listening, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.